Hi YouTube, my name is Jake and welcome to my channel. In this video, I want to share my thoughts on market volatility by sharing video clips of legendary investors Peter Lynch and Warren Buffett speaking about their opinions on volatility and the lessons we can learn. The recent trends in the financial market has been highly volatile due to uncertainties in the US presidential outcome, geopolitical relationship with the US and China, the economic impact from the coronavirus pandemic. Since the stock market is highly liquid, meaning you can buy and sell within seconds, volatility in the stock market is inevitable. Legendary investors Peter Lynch and Warren Buffett both are well known for beating the market consistently by 30% annual return, explains why the volatility is actually good rather than posing a risk for investors.
I love volatility. I remember when 1972 the market went down dramatically and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close. And I started buying at 7, but I kept onto it and it went to 1. It was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. The market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out what mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
Volatility does not measure risk. And the problem is that the people who have written and taught about volatility do not know how to measure, or taught about risk, do not know how to measure risk. And the nice thing about beta, which is a measure of volatility, is that it's nice and mathematical and wrong in terms of measuring risk. It's a measure of volatility, but past volatility does not determine the risk of investing. I mean, actually, take it with farmland here in 1980 or in the early 1980s. Farms that sold for $2,000 an acre went to $600 an acre. I bought one of them when the banking and farm crash took place, and the beta of farms shot way up. And according to standard economic theory, market theory, I was buying a much more risky asset at $600 an acre than the same farm was at $2,000 an acre. Now people, because farmland doesn't trade often and prices don't get recorded, they would regard that as nonsense, that my purchase at $600 an acre of the same farm that sold for $2,000 an acre a few years ago was riskier. But in stocks, because the prices jiggle around every minute, and because it lets the people who teach finance use the mathematics they've learned, they have, in effect, they would explain this away a little more technically, but they have in effect translated volatility into all kinds of past volatility in terms of all kinds of measures of risk. And it's nonsense. Risk comes from the nature of certain kinds of businesses. It can be risky to be in some businesses just by the simple economics of the type of business you're in. And it comes from not knowing what you're doing. And it is, if you understand the economics of the business in which you are engaged, and you know the people with whom you're doing business, and you know the price you pay and is sensible, you don't run any real risk. And I don't think Charlie and I, certainly at Berkshire, I don't think we've ever had a permanent loss in marketable securities that was, what, 1% maybe? Half a percent? I made a terrible mistake in buying Dexter Shoe, which cost us a significantly more than 1% of net worth, where I bought an entire business then. But I was wrong about the business. It had nothing to do with the volatility of shoe prices or leather or anything else. It just was wrong. But in terms of marketable securities, I cannot recall a case where we've lost. I mean, we've done a lot of things in securities that had a very high beta. We've done a lot of things in securities that had a low beta. It just, the whole development of volatility as a measure of risk, it's really occurred in my, and it's been very useful for people who wanted a career in teaching, but it is not, we've never found a way for it to be useful to us.
The volatility gives the investor an opportunity to buy stocks cheap rather than pose risk, because the risk of owning stocks actually comes from what the investors don't know. When the market dips, investors that don't understand the financials or the business will miss out on the opportunity by making investment decisions solely based on their emotions rather than analyzing the situation rationally with logic. This is why it is essential for investors to know the company's financials and thoroughly understand the business behind it to minimize the risk and maximize the return. Also, when it comes to investing in the stock market, most retail investors behave as if the stock market is a casino or a lottery ticket, believing that somehow if you buy or sell a certain stock at the right time, you can make quick and easy big money. However, this type of behavior is very similar to gambling, which is a zero-sum game. Stock represents the ownership of the company, meaning when you buy a share of Apple, you are buying fractional ownership of Apple. In addition, since the value of the stock is driven by the expectation of the financial performance of the company in the future or the rise in the market cap, a company that offers the most competitive and highly innovative products or services will outcompete its competitors, which will then make more money, thus increasing the market cap and make its stocks more valuable. On the other hand, gambling is a zero-sum game, meaning the game itself is designed statistically to favor the house rather than the players. Therefore, as the player continues to play the game, player will eventually reach the net benefit of zero, losing all of his money. Whereas investing, you have clear control over increasing the odds of winning by thoroughly researching and analyzing the market situations, analyze the company's financials, and understanding its business by reading the annual report. In the midst of chaos and panic, I firmly believe that there's always an opportunity, and this is why I also believe that the volatility in the market is something to embrace rather than to be fearful of. Know what you own and know why you own it. Be fearful when others are greedy, and greedy when others are fearful. These are my favorite quotes from Warren Buffett and Peter Lynch because it provides us insight, wisdom, and lessons that we can all learn to make better investment decisions. I hope that you enjoyed this video and leave a comment below on what you think about the volatility. If you like this kind of content, please give it a like and consider subscribing. Thank you for watching.